Did you know that about 80% of day traders lose money within the first year? Shocking, right? But here's another fact. Long-term investors often see success. This shows us something important. Investing isn't just about luck, it's about smart strategies. Now you might be thinking, investing is too complicated, or I don't have enough money to start. But guess what? You don't need to be a millionaire or a genius to be good at this. It's all about knowing the common mistakes and how to avoid them. In this series, we'll uncover the 12 most common investing errors. From the dangers of not spreading your risks to the traps of letting emotions rule your decisions. We've got it all covered. Think of it as your roadmap to smarter investing. Are you ready to take control of your financial future? Buckle up because we're about to dive into some game-changing tips and tricks that could make all the difference. Let's make your money work for you. Chapter 1. The danger of putting all your eggs in one basket. Did you know that investing all your money in just one type of thing, like only stocks or just real estate, can be super risky? It's like betting all your money on red and roulette. Not the best strategy, right? So here's a better idea. Spread your investments across different things. Think stocks, bonds, real estate, and maybe even some cash. There's this cool thing called diversification. It's like making a smoothie with different fruits. Each fruit adds something special, and together they make something awesome. Diversifying your investments works the same way. It's not just me saying this. Experts like Warren Buffett agree that diversification is key to reducing risk. Did you know that during the 2008 financial crisis, people who had all their money in stocks saw their investments drop by over 50%? Scary, right? But those who had a mix of stocks, bonds, and other assets didn't see as big a drop. That's the power of not putting all your eggs in one basket. Chapter 2. The hidden bite of investment costs. Now let's chat about something sneaky. Investment costs. High fees are like termites. They quietly eat away at your investment returns without you even noticing. It's important to keep an eye on these fees, as they can really add up over time. You might think a 1% fee is small, but over 20 years, it can eat up almost 20% of your investment returns. That's a lot of cash. So what can you do? Look for low-cost options like index funds. Index funds are like the smart shopper's choice. They give you a bit of everything in the market at a low cost. John Bogle, the founder of Vanguard, once said, "The miracle of compounding returns is overwhelmed by the tyranny of compounding costs." This means that even though your investments can grow, high costs can seriously slow down that growth. Chapter 3. The trap of chasing yesterday's winners. Have you ever bought something just because it was popular, only to find out it wasn't that great? Investing can be like that too. Just because an investment did well last year doesn't mean it will this year. It's like following a GPS that's showing you yesterday's traffic. Not very helpful, right? History tells us that investments can be unpredictable. In the 1990s, tech stocks were the big thing, but by the early 2000s, many of them crashed hard. So chasing past winners can be a risky move. A smart strategy is to look at the big picture and think long-term. It's not about picking the hottest stock, it's about having a solid plan. Remember, slow and steady often wins the race in investing. Chapter 4. Riding the roller coaster of market ups and downs. All right, let's talk about the stock market roller coaster. It goes up, it goes down, that's just what it does. If you react every time it dips or soars, you're in for a wild ride. During the 2020 pandemic, the market dropped like a rock, but then it bounced back quicker than anyone expected. Those who stayed calm and didn't sell their investments came out pretty okay. The key is not to let short-term changes scare you off. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." This means if you can stay cool and keep your focus on your long-term goals, you're more likely to come out ahead. Chapter 5. The importance of regular money checkups. Just like visiting a doctor keeps you healthy, giving your investments regular checkups is key. Why? Because things change, your life, the market, everything. You gotta make sure your investments still fit your goals. Imagine this. You set up a fitness plan but never check your progress. Doesn't make sense, right? Same with money. Maybe you're saving for a house now, but in a few years, it could be for your kids' college. Checking in helps you stay on track. A study showed that people who reviewed their investments annually had better financial outcomes. It's like having a map for a road trip. You need to check it regularly to make sure you're still going the right way. Chapter 6. Playing it too risky or too safe. Investing is a bit like choosing a roller coaster. Too scary? Not fun. Too tame? Boring. You need to find your sweet spot. Not understanding the risks can lead to nasty surprises, and being too cautious can mean missing out on good opportunities. Here's a fact. In 2008, those who took crazy risks got burned when the market crashed. But on the flip side, Keeping all your money under a mattress isn't smart either. Inflation can slowly eat away at it. Balance is key. Warren Buffett says, risk comes from not knowing what you're doing. So learn about different types of investments and what risks they carry. This way, you can choose wisely and sleep well at night. Chapter 7. The need for a solid game plan. Building a house without a blueprint? Chaos. Investing without a plan? Same deal. Having a clear strategy keeps you focused and helps you make smart choices, even when things get crazy. Your investment plan should be like a tailor-made suit. It needs to fit your goals, timeline, and comfort with risk. A one-size-fits-all approach doesn't work here. Like, saving for a vacation next year is different from planning for retirement 30 years away. A Harvard study found that those with a written financial plan were 60% more likely to increase their investment returns. Writing down your goals and how you plan to achieve them makes a big difference. Chapter 8. Falling for hot tips. Who hasn't heard a can't-miss investment tip from a friend or on social media? But here's the truth. Investing based on rumors is like gambling. Always do your own research before putting your hard-earned money into something. Think of it this way. Would you buy a car just because someone said it's great? Probably not. You'd check it out yourself, read reviews, maybe take it for a test drive. Treat your investments the same way. Peter Lynch, a famous investor, said, know what you own and know why you own it. This means don't just follow the crowd. Understand what you're investing in and why it makes sense for you. Chapter 9. Keeping cool. When money emotions run hot. All right, folks, let's chat about emotions and money. Mixing the two can be like oil and water. They don't mix well. Have you ever bought something on a whim when you were super excited or really down? Investing can be like that too. It's easy to get caught up in the hype. Like when Bitcoin was all the rage, lots of people jumped in without thinking. But many who bought at the peak saw huge losses when it crashed. The lesson? Don't let emotions drive your investment bus. Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful. This means don't follow the crowd. Stay calm, think long-term, and stick to your plan, even when everyone around you is losing their heads. Chapter 10, the myth of perfect timing. So, you think you can time the market, huh? It's a bit like trying to catch a falling knife. Risky and often ends badly. Even professional investors struggle with this. The market is super unpredictable, and timing it perfectly is nearly impossible. Here's a fun fact. Did you know that if you missed just the 10 best days in the stock market over the last 20 years, your returns would be significantly less? This shows that it's time in the market, not timing the market, that counts. A study by Vanguard found that trying to time the market often leads to lower returns. It's better to have a consistent investment strategy, like setting up a regular investment plan and sticking to it, come rain or shine. Chapter 11. Ignoring tax implications. Taxes and investing are like peanut butter and jelly. They go together. Ignoring the tax side of investing can eat into your returns. It's important to understand how your investments will be taxed and plan accordingly. For example, did you know that long-term capital gains are taxed at a lower rate than short-term gains? This means holding your investments longer can save you money on taxes. Smart, right? There's a saying, it's not what you earn, it's what you keep. This means it's important to consider the after-tax return of your investments. Making tax-smart decisions can really add up over time. Chapter 12. Overconfidence and personal ability. Last but not least, let's talk about overconfidence. Thinking you're the next Warren Buffett because you picked a couple of winning stocks? That's like hitting a few good shots and thinking you're ready for the PGA Tour. A study found that individual investors who trade frequently tend to underperform the market. Why? Because they often overestimate their ability to pick winners and time the market. Buffett advises, be fearful of overconfidence. Remember, investing is not just about picking stocks, it's about having a solid overall strategy. Don't overestimate your abilities. Instead, focus on learning, planning, and staying disciplined.